All right, we are going to start today's session with a conversation with Ashish Jain from 3Lines Ventures. Ashish, welcome to the show.
Thank you, Shamana. Pleased to be here.
Well, let's first and foremost get you introduced to our audience. Tell us a little bit about yourself and 3Lines.
Oh, certainly. So 3Lines is an early stage software technology venture fund. It's a startup in itself. We started about 3 years ago. I joined the fund about 9 months ago. I was at GE Ventures before that, running the AI accelerator at GE, incubating industrial 4.0 companies. And we'll talk more about 3Lines. As I said, as a software technology fund, we are cross-border, investing both in US as well as India. And we are seed through Series A kind of investments. Though we are a startup, all the partners actually have considerable operating as well as entrepreneurships as well as incubation experience. So the partners are not newbies, but the fund is relatively new with the. Sorry, go ahead.
How big is the fund?
So we have around 10 million under management right now, and we are actively raising our second fund. Expect close of about $50 million fairly soon, and we have the initial tranche already identified.
Okay, and talk about geography. You said you do cross-border India and US. Does it mean all of India and all of US? And are you where exactly are you? Are your physical presences?
Yes, no, that's very important part of our investment hypothesis. We are looking beyond Silicon Valley for sure, especially for early stage. We believe that there are tremendous opportunities, exceptional founders outside emerging now, partly because of incubators and accelerators, how they're growing. So we are about 10 innovation clusters or innovation hubs, you may want to call them, between US and India. So we do get deals from everywhere, obviously, but majority of our investments are in US. We are doing a lot in Boston, New York, Dallas, Denver, some from Silicon Valley for sure. In India, it's Bangalore, Northern India, as well as Hyderabad. So we are focusing on about 10 innovation hubs, and we actually have a very strong individual LP presence in these hubs. So we try to stay ahead of the deal flow and improve our deal flow by actively engaged with the early stage innovation and acceleration and incubation.
And where are the general partners located?
So we are a distributed team. I'm based out of New York City, and my other two partners, Kamlesh Dwivedi and Krishna Kunapalli, they are based out of Denver, Colorado.
Okay, very good. That gives us an idea. So the next thing I want to do is define seed. So I'm sure you are observing how the ecosystem has evolved. In the mid-90s, when venture capital started to become hot with the advent of the internet, there was seed and there was Series A. Now the picture is very different. 25 years later, there is, pre-seed, seed, post-seed, pre-Series A, small Series A, large Series A. So where in that continuum do you position yourself?
No, you're absolutely right. There has been a tremendous amount of innovation, both in terms of, venture investment instruments, as well as, the definition and the amount of capital which is available, resulting in, rounds getting bigger and things like this. So yeah, for us, seed means a company with a team, a product, fraction with initial customers, and about $500,000 in revenue. And in valuation term, it could be a broad valuation, but around 8 million kind of valuation is what we would consider as a seed. Again, these are prototypical examples. There are tremendous amount of variations in this.
And what size checks are you writing in that scenario?
For seed, we typically are going to make about $750,000 as part of our seed investment. Again, typical. It could really go as low as 100,000, and it could be slightly more in many cases based on valuation and how much we like the firm and what kind of value we can provide to the firm. That's really what guides, not as much valuation as much as what kind of value we can provide besides the capital. So once we determine that, we take a much bigger round for some of them.
Let's pursue that a bit. What kinds of ventures, what sectors, what styles of ventures do you think you add the most value to, and hence what you're looking to invest in?
Certainly. So yes, so we are a technology fund. We absolutely are lovers of technology. We are techno geeks. So we invest in three broad disruptive areas. One is exceptional founders and companies in all related to future of work. As we know, this is how the workforce is changing, all the way from HR practices to coaching to the entire hiring with the gig economy coming. So we are investing a lot in the future of work. Second one is around Industry 4.0. That's a white space in our view right now. Lots of focus have been gone towards enterprise, but Industry 4.0 is really coming about. And partly that's really what I was doing at GE, so we have a lot of expertise around that.
And that is what you call Industry 4.0 is the industrial space in general, the
yes.
IoT industrial kind of.
Yes, IoT certainly, industrial IoT is certainly part of it. Supply chain, logistics, digitization, digitalization, automation, all aspects of. So that's what Industry 4.0 means to us. And the third one clearly as AI-enabled enterprises, right? All the way from automating workflows to personalization to improving user experience. So these are really the three broad areas. We are really pretty much vertical agnostic, though we will not go in verticals we don't understand. So for example, biotechnology, therapeutics is not what we do. But we have a broad understanding of the verticals between our initial LPs and the advisors and the GPs. So we are a technology-focused fund, as I said, around the three broad areas we covered.
Now, talk about a few of your investments, maybe do a couple of case studies, and specifically what I'm looking to do is have you talk about the investment, the company, what they do, and specifically about when you encountered them, what did they have, and what was it about these companies that attracted you and you pulled the trigger to invest in the companies?
That actually it will exemplify our investment hypothesis actually. So I'll go over our three recent investments. The first one we invested in is a company called SOAR, SOAR, and that's really a future of work, part of our future of work. So the company provides AI-enabled coaching and mentoring. And the work the company is doing is actually based on some very foundational and fundamental work which happened in organizational psychology and industrial psychology based on finding individual strengths and then trying to complement a program around individuals core strengths. So the founder, Paul Allen, is a repeat entrepreneur. He was the founder of Ancestry.com and Family Link. So he had 2 exits. And now he's building a world-class team of advisors to essentially allow people to assess their strengths, and then using AI and content, which is now available in a digital format, to really provide them 24/7 kind of an environment to learn, mentor in a one-on-one setting as well as in an AI-assisted setting. So this is, again, we try to get ahead of the deal flow. So Paul connected through our LP network with us. He wanted to build a very special company with very special capital structure, and we were very flexible about that. That's one of the reasons why we could connect with Paul.
What is special about the capital structure?
We can talk about it. There is certainly a trend towards bigger and bigger funds going forward. And Paul was very concerned about making sure that early investors and early employees, continue to have, because we are taking faith in it. We are an early stage fund, as you know. And so how do we protect the interests of the early stage investors? So he has done some very clever, I wouldn't want to say clever, something very foundational, I would say. Plus, we believe him. So he has created, class structures which we were very comfortable with. I'm not sure how many other VC firms would become comfortable with those, but we believe in the team. We believe in what they are doing, and we were very happy with the kind of class structures he had created. So we went ahead and invested in his company.
And in this case, did it come with the $500,000 revenue that you said you look for in such investments?
Yes. So operationally, they're pretty close. I don't look at from a deal flow side. Our deal screening council actually looks at some of those. So I don't know the exact number, but yes, they had a lot of traction, and they are actually continuing to work with some of the largest training and coaching platform services companies to really have a B2B2C kind of a relationship. So yes, this company we were quite comfortable with the stage they were in.
Interesting. And what is the trend that you're seeing in this case? Of course, you have a serial entrepreneur who has had 2 exits, so presumably he has money. So is this a founder bootstrapping with his own money to that extent and then raising money after reaching a certain amount of revenue traction?
Yes. So Paul is the class of founders who's really bootstrapped quite a bit. And again, he was looking for like-minded investors who really believed in cause. It's definitely impact as well as for profit. And as I said, we see tremendous value going forward as workforce gets more diverse, more geographically, distributed, and the human resource practices really adapt to really cater to such a workforce. We believe that this company is going to be foundational, and his philosophy, his experience, we just loved it.
Okay, very good. And the company is based where?
The company is, most of the key employees are actually based out of Utah, Colorado. I'm sorry, Utah, yes. Salt Lake City, Utah.
Interesting. Utah is producing a lot of very good companies, and Utah has an excellent culture of bootstrapping. So we have seen a lot of successes out of Utah.
So we are exactly seeing the same thing. As I said in the beginning, Silicon Valley is a great place, but we are seeing phenomenal founders coming from everywhere right now. This is the time
that's
for our
good thing because it's so expensive. Silicon Valley has become so expensive, so you can't really hire a lot of people in Silicon Valley anymore.
Right. So with the rise of the mega funds, and if you're a pure growth-oriented rocket ship building kind of a company where you really want to escape by sheer capital, I guess you would go there. But we are looking for founders who are passionate, companies which are going to have impact, and they really
All founders cannot play that game of hiring with heavy-duty salaries and trying to compete with Google and Apple and Facebook for talent. That's just not a playable game for small funds. Do you want to do another example of another investment that gives us some insight into your thinking?
Yeah, so let's take one from India. So we talked about India as I would not even call it emerging anymore because it's come of age.
Has emerged.
We'll talk about, exactly. I'll talk about Arzu. We call it India is going through Innovation 3.0 right now. So Innovation 1.0 was all around business process outsourcing. Innovation 2.0 was IT services company, as you saw. And now we are really talking about Innovation 3.0, because like these founders are looking beyond just replicating, like a fast follower of companies that are successful here, and are now looking into supply chain, looking into platforms for IoT, for EV kind of vehicles, automation of the supply chain. So Arzu is one of them. It's ARZ as in zebra with 3 O's. It's again, they are ex-Flipkart employees. They saw an opportunity to digitalize the supply chain for the B2B retail, and they are executing it perfectly. So we really love that team. India, as many would know, has gone through some macro changes around tax structure. You know how taxation happens in India. Demonetization actually resulted in more, I would say, the digital economy has really picked up. Yeah. So again, they have a SaaS platform, started with 3 or 4 cities and expanding almost literally on a weekly basis. So this is another example for us, great founders, very passionate, great experience, and tremendous growth area for us.
You're comfortable doing ventures that are India-based ventures facing the India market?
Yes, so that's again we do as part of our portfolio construction. We are certainly going to look for companies, India for India kind of companies, but we are also going to really look for India for global kind of companies because we can add a lot more value to those portfolio companies besides just providing capital. So we have not yet, but we are certainly looking. We are very advanced stages of certain deals where those entrepreneurs are essentially, replacing a lot of legacy systems using IoT and mobile and voice first kind of platforms, and they would really scale globally very, very well. So yes, so both India for India as well as India for the world. We are investing in both of those types.
Okay. So I have a slightly different question, which is, which is a question that I ask people who are running small funds. The micro VC trend is very hot right now, and there's a lot of innovation happening in the small venture capital fund category. There is a class of VCs that are still purely chasing unicorns. They want to go from 0 to $100 million in 5 to 7 years, billion-dollar TAM, etc. But there is a class of funds that are looking at small capital efficient ventures and potentially seek early exits. Can you comment on this trend and where you sit in that spectrum?
Yeah, I think it's so our current fund is, our investment thesis is not for early exits. So we want to be true to our investment hypothesis and want to be true to our LPs. We don't want to play loose and fast. So we are currently not investing in those companies. However, having said that, I'm going to
push back for Ashish. I'm going to push back. I don't think the people who are doing small capital efficient ventures and seeking early exits are not being true to their limited partners. That is an allusion that I have to push back on. It's an inappropriate allusion.
It all depends upon how you have your portfolio construction hypothesis and what have you told your LPs in terms of your timeline.
That's right. So they have told their LPs that that's what they're going to do. So they're not being untrue to their LPs.
That's precisely what I'm saying. I'm not saying they are being untruthful. I'm saying that we don't want to be untruthful to our LPs because that's not what we have promised.
Why would you be? You raise a fund on the basis of an investment thesis. I'm asking you for that investment thesis. So obviously I assume that your LPs buy into that investment thesis.
Correct, exactly. So I'm saying that as part of that investment thesis, small early exits are not part of our investment thesis.
Not part of your investment thesis. That was my question. You're a traditional fund that is looking for the traditional venture dynamic.
Absolutely.
Yeah.
Now, we certainly see a family of funds. So one of the things I will just add is, having said that, we believe in early stage, early exits kind of fund. And as a part of our what the brand and the platform we are building, we certainly expect to have a fund which is exclusively focused on early exits. Actually, we're planning to actually have a fund which is going to actually focus on innovation plus, which is going to go all the way and seed innovation. So those are all we have planned to do, but I answered you in the context of the fund which we are running right now.
Fund. Yeah. Right. Okay. All right, so I think we understand the fund, and one of the reasons why I do these things of inviting investors to come and talk to me as well as to our community, and then we obviously have this available in the community for people to refer to, is so that we can start working together. So this, is the beginning of hopefully a longer relationship, and we'll start looking at deals together and so forth.
I think you're doing a great service, and now that I know more about it, it being virtual and starting a dialogue, especially around the trends and what you just mentioned, it helps with the LP education as well, I would say, because a lot of LPs, family offices are, don't quite value what it goes into a portfolio construction hypothesis, for example. In my view,
you have to have an investment thesis. You cannot just go blindly spray and pray. You have to have an investment thesis, otherwise you will not be successful.
And in our view, the GPs earn their keep. I mean, a lot of people have deal flows. There are two places where the GPs earn their keeps. One is getting ahead of the deal flow and not following it. And number two is how sophisticated is your portfolio construction hypothesis. That's really where we are. And I'm glad, actually, that it helps our cause quite a bit. So I appreciate you doing this.